from WBRN Radio and on the Bostonred Network. The numbers man part, this week in economics. We're a little bit late. This is primarily to last week, but we do have current information on today, the 19th of March, 2019. Numbers man here from the Jerry Pippin broadcast booth. We have a sad note here. Professor Alan Kruger, who was a part of both the Clinton administration and the Obama administration, died over the weekend. He served as the chief economist for the Department of Labor during the Clinton administration and chair of the Council of Economic Advisors during the Obama administration. In fact, he had delivered a paper over the weekend, I believe at Stanford University, on a national income program period there. His family, of course, requests that they have some space, which is known. He was at Princeton. He was a professor, done teaching there. And the paper that he did at Stanford, why is basic universal income so controversial? We've been trying to find a paper, haven't been able to find it as of yet, but he did receive the Kershaw Prize by the Association of Public Policy and Management. That was in 1997. That's given to people under 40 years of age. And he was also an avid music fan of David Bowie and Bruce Springsteen. And his latest research, a forthcoming book on economics, this is interesting here. It was due for release in June of this year on economics and the music industry. Alan Kruger, 58 years old. On a very sad note, we'll give some of the figures here from manufacturing, the job openings, the survey of consumer sentiment that's out of the University of Michigan. We'll talk about that. We'll start with manufacturing, losing steam here. And that will come, P&I will come from the Institute for Supply Management. This was released actually on the 1st of March, a little older now, but the PMI stood at 54.2%, new orders, production, employment. Here, the economic activity in the manufacturing sector expanded in February, and the overall economy grew for the 118th consecutive month, and that is from the manufacturing SMI report on a business. Report was issued by Timothy Foray, chair of the Institute for Supply Management Business Survey Committee. It was, again, the number was 54.2, a decline of 2.4 percentage points from January, reading of 56.6. The new orders index registered 55.5. That's a decline of 2.7% from January's reading of 58.2. The production index registered at 54.8, and it was a 5.7% decrease from January. What's surprising here was the January numbers. Usually when we begin Q1 of a year, it can either be an extension of the previous Q4, or it can be in a new ground. Over the long haul, we'll say, generally because of winter, etc., January you'd expect to be a little bit less. However, though, things were different here. The production index registered 54.8. Again, that was 5.7% decrease compared to January's reading of 60.5. The employment index registered at 52.3. Supply delivery index registered at 54.9. That was a a 1.3 tenths percentage decrease from January's, a reading of 56.2. Inventory index registered at 53.4. Now that was an increase of 6 tenths there from January's reading of 52.8. The price index registered at 49.4, a 2 tenths decline from January's reading of 49.6. Comments from the panel reflected continual expanding business strength supported by notable demand and output, although both were softer than the previous month. Demand expansion continued with new orders index reaching the mid-50s, the customer inventories index scoring a lower and remaining too low, and backup orders returning to the low 50s expansion level. Consumption, as production and employment, continued to expand, but fell a combined 8.9 points from the previous month's levels. Input expressed as suppliers' deliveries, inventory, and imports stabilized at the mid-50s level. Inputs continued to reflect easing business environment confirmed by a price contraction. Exports continued to expand at slightly stronger rates compared to January. The manufacturing sector continues to expand, but inputs and price indicate easing of supply chain constraints. That's from Mr. Foray. That's Fiore. I hope I pronounced his name right. Of the 18 manufacturing industry, 16 reported growth in February. As the following orders: printing and related activities, textile mills, computer and electronic products, electrical equipment, advanced appliance and components, fabricated metal products, paper products, wood products, primary metals, chemical products, food, beverage, and tobacco products, miscellaneous manufacturing, petroleum and coal products, transportation equipment, machinery, furniture, and related products, plastics, rubber products. The only indicators reporting a contraction was non-metallic mineral products. And this is what some are saying. Demand remains healthy at the beginning of 2019. However, growing concerns of what could be around tariffs that didn't materialize in March, or further escalating price increases on already constrained electronic components. Expect to see increased lead time and prices through Q1 and Q2. Again, this is to the psychology of the market. Strong start to the year, though weather has been a challenge, as chemical products, transportation still fairly steady with production and services. Economy generally strength, especially in manufacturing. Cost pressures and tariffs challenge persist, but are manageable. The general outlook is for stability and potential improvement in the second half. That would be Q3 and Q4 alcohol and beverage products. And this is some of the things here. We'll just append this. We won't get into these numbers. Commodity price up, commodities up in price. And these are various commodities here: aluminum, electronic components, paper-based products, plastics, printed circuits, board assemblies, steel and steel hot roll and steel production. Commodity prices down: aluminum, caustic soda, memory, that's good, oil, steel and hot roll, and so forth and so on. Commodities in a short supply: electronic components and resistors. Okay. Manufacturing expansion in February, as the PMI registered 54.2%. a decrease of 2.4% here. And this is just a rehashing. We will append it for you to look at. Job openings, a more recent from the Bureau of Labor Statistics. Job openings and labor turnovers, this would be in January. Job openings a little changed at 7.6 million in the last business day of January. The Bureau of Labor Statistics reported over the month hires and separations were little changed, 5.8 million and 5.6 million respectively, including a separation. The quits rate was unchanged at 2.3%, and layoffs and discharge rate was little changed at 1.1%. Release includes estimates of numbers and rates of job openings, hires, separations. For the, I'm not certain, I mentioned this before, for the non-farm sector, that's left over from the 40s. The release also included the 2018 annual estimate for hires and separation, the annual number of hires at 68.9 million, the annual number of quits at 41.1 million. Increased in 2008, the annual number of layoffs and discharges at 21.9 million, edged up in 2008. Job openings, a little change. I think we talked about that. The job opening rate was 4.8%. The number of job openings, a little change for total private, and increased for government at 59,000. Job openings increased. The number of industries, the largest in wholesale trade, at 91,000. Real estate and rental and leasing at 60,000. Hires were a little changed in January at 5.8 million. The rate was 3.9%. Separations, including quits, layoffs, and discharges, and other separations. Total separation referred to as turnovers. Quits are generally voluntary separations initiated by the workers. Therefore, the quits rate can serve as a measure of the worker's willingness or ability to leave the job. Layoffs and discharges are voluntary separations initiated by the employer. Other separations include separations due to retirement, death, disability, transfers to other locations, as with the GM workers. The number of separations little changed at 5.6 million in January. The total separation rate was 3.7%. The total number of separations little changed for private and for government. Total separations in real estate and rental leasing at 20,000, but a decrease in federal workers at 11,000 there. And that federal shutdown is now showing up. The number of quits was a little changed at, this is in January, at 3.5%. The quits rate was at 2.3%. The quits level was a little changed for private, but increased for government at 20,000. Quits increased in arts, entertainment, and recreation at 19,000. State and local governments. Education at 17,000. Quits decreased in federal government, a negative 6,000. The number of changes was, of quits was changed, little change in all four regions. Layoffs and discharges at 1.7 million. Layoffs and discharge rate was 1.1%. Net change in employment. When the number of hires exceeds the number of separation employment rises if the hires level is steady or declining. Conversely, when the number of hires is less than the number of separations, employment declines, and even if the hire level is steady or rising. Over the 12 months ending in January, hires total 69.2 million, and separations total 66.3 million, yielding a net employment gain of 2.8 million. In 2018, there were 68.9 million hires, an increase of 3.3 million from 2017. Total separations, sums of quits, layoffs, discharges, and others rose by 2.6 million in 2018 to 66.1 million. Quits rose for the ninth consecutive year, reaching 40.1 million in 2008. That's up 2.4 million. Quits comprise 61% of the separations. Layoffs and discharges edged up 307,000 in 2018 to 21.9 million. It comprised 33% of separations. Of the separations, of a separation edged down by 44,000 in 2018 to 4.1 million, compared to 6% of the total separation. Annual hires in 2018 was 46.3%, an annual average of the CES employment level. This rate has trended upward since 2009, the official end of the Depression, although it did linger around. But the annual total separation rate in 2018 was 44.3%. The annual rate for components of total separation, 26.9% for quits, 14.7% for layoffs and discharges, and 2.8% for other separations. We'll also append this one. I think this is where we quit. And then you can look at 2018, January, December, and January of 2019 is here. And that's for job openings. In January, basically about the same, 758, and that was the number opened. And it was what, 5 in the thousands, at 525 in 28. About basically about the same. Hires was 517, and it was in December of 2018. In January of this year, 5801. And there's a long chart. I won't go into it, but it does give you an idea by industry if you're doing some work here for comparison reasons. In accordance with the job openings and labor turnover survey, this is called JOTS, has been revised to reflect the annual update to current employment statistics. That is CES survey there, and the levels not published are ratio adjusted to the CES, and you can find all of those tables here also. And these are revisions were not published, and it also gives the numbers. Example, in January of 2018, 6230. In December was 7335, and what the revision was 7479, and the difference 144. So if this is previously not published. Much better data sets here than what we had originally, so we can sort of look at this. And it has some nice technical notes here. Defining employment. Employment includes persons on the payroll who worked or received pay for the pay period that included the 12th day of the reference month. Job openings is collected from the last business day of the reference month, and this is good when they defined separations, the level, and the total number of employment terminations occurring at any time during the reference month is reported by the type of separation, whether it be a layoff, discharge, or etc. So this, you'll get to see this. The survey of consumer confidence, it's from or a survey of consumers, it's called now, from the University of Michigan. This is for March. It was released, the next release will be on the 29th of March this year. Nonetheless, the index of consumer sentiment in March was at 97.8. It was 93.8 in February, and it was 101.4 in March of last year. So you can see the net change there, month over month, 4.3% year over year at negative 3.6%. Current economic conditions at 111.2 in March. It was 108.5 in February of this year. And in March of last year, you can see where this is going. It was 21.2%, and the net change year over year was a negative 8.3%. The index of consumers is standing at 89.2. In March, it was 84.4, and it was 88.8 in March of last year. A 5/10 there from Dr. Curtin. He's the chief economist there. Early March gains in sentiment was entirely due to households with incomes in the bottom two-thirds of the distribution, whose sentiment rose from a 97.4 rose to 97.4 from a 90. In February, sentiment fell amongst households with incomes in the top third to 94.5 in early March, from 101.7 in February. The difference that accounts for the divergence was household evaluated their personal finance as lower income households expressed much more positive assessments. The divergence was due to a month-long jump of 1 percentage points in income expectation amongst the middle and lower income, compared to a change of 1/10 percentage points among those incomes in the top third. Rising income expectations were accompanied by a lower expected year-ahead inflation rates, resulting in more favorable real estate income expectations. Moreover, all income groups voiced more positive prospects for growth in the overall economy during the year ahead. Since households with incomes in the top third account for more than half of all consumer spending, cautious observers will conclude that the latest data are another indication that the end of the expansion is in the distant horizon, which may have been true, but the current levels of consumer expectation at 97.8 is hardly indicative of an emergency downturn, even amongst household incomes in the top third. Sentiment index at 98.5 and 97.4 in the bottom two-thirds. The data indicates that real consumption will grow about 2.6% in 2019, and the expansion will set a new record length by mid-year. It's a very interesting conclusion of Dr. Curtin here. It's very, very difficult to assess this in any kind of uniform manner. It is very, very, very tricky. The tariffs have been out of your newspapers, whether you're dealing with the various newspapers, the Washington Post, etc., the more financial-oriented newspapers like Reuters or sites, I should say, CNBC. Some of the business sites, they're all over the place in terms of where this economy is going. In the past, we've looked at the trends, and what it's telling one, if it's dealing with the lower part of the economy that's pushing consumer spending, there have been some increase in wages there. Costco moving to a base of $15 an hour, and Amazon already moving to $15 an hour. And the push by Bernie Sanders and Elizabeth Warren to move to that flooring of at least 15,000. They've changed the language a little bit, of at least 15,000 an hour. So that in itself has enhanced the view of people that this will be the year that there will be more equity in an inequitable society, inequitable economy. Thus, there would be some optimism there, but at the same time, the tariffs have left the scene as like Elvis, and they have not been on the front page. Negotiations are still continuing, but in terms of headwaters, we have Brexit, which is in total collapse in the UK. The UK being one of the, I believe it is the one or two business, probably one of the U.S. in Europe, and then Germany. Looking at European economies is not all rosy. China has been doing some quantitative easing types of, we used to call in the old days, pump priming, to bring the economy not back to where it was several years ago, but up to acceptable levels. So we'll see, as they say. Incidentally, Dr. Curtin will have out a book, Consumer Expectations, Macro Foundations and Micro Foundations and Macro Inputs from Amazon. I'll plug his book. Happy to do that. And let me see here. Looking at CNBC. We'll incidentally have Jerome Powell's testimony before the House Finance Committee. We've had that sticking around. We've also got the Senate, but we'll do the House after this report ends. Jamie Dimon, he is saying the U.S. We have split the U.S. economy, leaving the poor behind. In manufacturing output, let me see, where did we go? Falls for a second straight month. Now this is on March the 15th. Let's take a quick look at this. This is from CNBC. In February, I think we were looking at January, the data offers evidence of a sharp slowdown in economic growth in early Q1. Federal Reserve said on Friday manufacturing production dropped 0.4 last month, held down by declines in output of motor vehicles, machinery, and furniture. The U.S. Manufacturing output fell for the second straight month. The Federal Reserve said on Friday it dropped 0.4%. Last month held down by declines in output of motor vehicles and machinery and furniture. The data for January was revised up to show output falling at 0.5% instead of 0.9%. This is a Reuters article here, more or less. They're talking about polling there, manufacturing production added to SALT reports ranging from retail sales to housing. Goldman Sachs is forecasting, gross domestic product will rise by 0.6% amortized rate in the first quarter. Economic growth at 2.6% in Q4. And that's pretty much general agreement here. And one of the things always to note about these predictions, depending on many things, but you do have a lot of uncertainty out there. You have uncertainty coming September, and remember 2020 is a election year. But the in terms of renewal of the debt, the federal budget will expire in September, the end of September. We start talking about a new federal budget, debt ceilings, etc. coming out there. Now, manufacturing, which accounts for 12% of the economy, is losing steam as a boost to capital spending from last year's 1.5 trillion tax cut fades away. That is one of the big problems with that type of what we used to call pump priming or stimulus. It doesn't last forever. And when it does fade away, if economic conditions are, say for instance manufacturing, or even could be the market, behaves as if it were a norm had occur, problems occur, because then you have bottlenecks, stocks go down, etc. Activities being crippled. They mention the trade wars, but not so much there. Drop in manufacturing output was offset by gains in utility and mining, leading to a 0.1% rise in industrial production in February. Industrial production fell 0.4 in January. Utility output rebounds, at 3.7% last month as colder temperatures boost demand for heat, no doubt. Energy output dropped 0.9% in the prior month. Mining output rose 0.3%. Gas oil drilling increased at 2.8% after a 2-month decline. Capacity utilization for the manufacturing sector, a measurement of full firms are using their resources, fell 75.4% last month from 75.8% in January. Very important figure to look at. Overall capacity for the industrial sector dropped to 78.2% from 78.3%. It is a 1.6% below the average. Now, this is the average from 1972 to 2017. This is the Fed outlook here for inflation. The Fed will have a meeting, incidentally, tomorrow. So again, there's not much going with that. Let's move on here. We have a lot of indicators. Jobless claims increased more than expected. This is March 14th, a few days ago. We'll take a quick look at this. We always do. Number of people filing for unemployment benefits increased more than expected. Initial claims rose to 229,000 from a week ending March the 9th. Initial claims for state unemployment benefits rose 6,000, seasonally adjusted 229,000 there. Economists at Reuters have forecast claims rising 225,000 in the latest week. Claims have been hovering in the middle of their 200 to 253,000 range there. Hiring is being constrained by a weakening economy as a stimulus. Of course, this whole thing is stimulus disappearing. And Beijing and demand overseas. And, of course, in Britain, what's going on Tuesdays, a report showed a number of people receiving benefits after the initial week of aid increased 18,000 to 1.78 million for the week ending March the 2nd. The 4-week moving average, which is a better indication of so-called continuing claims, dropped 1,000 to 1.77 million. Import prices rose more than expected in February as fuel prices surged. That is something that you expect to be part of what is going on in the industrial economy in this particular year. While we're over at CNBC here, Starbucks revamped its loyalty program. I used to be in that thing. It jumped out of it a long time ago. Netflix will not join Apple TV service. This is Jamie Dimon, actually here. He is at J.C. Morgan. He said, we have split the U.S. economy, leaving the poor behind. A lot of people are talking about what Dr. Kruger talked about, the late Dr. Kruger. U.S. economy has essentially been split into those benefiting from thriving corporate rations and those who are left behind. I don't want to be a tone-deaf CEO while the company is doing fine. It is absolutely obvious that a big chunk of people have been left behind. 40% of the American people make less than, and this is atrocious, less than $15 an hour. 40% of Americans can't afford a $400 bill, whether it's a medical bill or fixing their car. 15% of Americans make the minimum, and 70,000 dying from opioid addiction annually. He was speaking at an event at the New York headquarters, unveiled a new $350 million program to boost job perspectives for underserved communities. J.P. Morgan, he's the chair and a CEO there, making progress about involving these issues and working with local organizations. Their companies have to be involved. Businesses can't bypass all these sectors of society that have suffered a little because they can do it themselves. Damone goes on to say, we made a mistake by ignoring some of these things. If we don't, society is going to get worse, and because these problems aren't aging well. The bank's new 5-year program that was announced on Monday includes $20 million to $200 million. Develop training programs for in-demand digital and technical roles. $125 million to boost collaboration between workers and education systems. Another $25 million to help spread labor market data and analysis to enable companies to focus on ways to lift people out of low income. So that's the type of work late Professor Kruger was involved in. It's signaling this would be a much more demanding type of program. He goes on to say, calling the education system broken. He said his bank has stopped giving philanthropic dollars to colleges years ago, and said the company is focusing on community college and training programs. Harvard and Princeton are not philanthropic. Helping these kids is, and this is good to have a shift to this type of a program. Now let's move on here. Actually got him twice. And we already talked about the Fed survey here. According to CNBC's Fed survey, the average forecast for gross domestic product this year will be, and we've been seeing these figures, 2.3, 2.6 percentage growth, well below what DJ Trump was talking about, 3.5 to 4%. And in March, set sharper this year, according to respondents to CNBC's federal survey for March. And now in 2018, growth set to slow. It was in 2018 at 3.1%. The estimate is 2.3, and then 2020 at 2%. Now, you go to this realization, and 2020 being an election year, you're going to have a great difficulty talking about 3.5% when you are literally what would be 0.5% down. If Trump wants 2 terms, he needs to make a China trade deal and start lowering tariffs across the board. That is from Hank Smith, a co-chief investment officer at the Hartford Trust Company. This will cause business confidence to rise and capital spending to increase and stimulate the economy. I'm a little doubtful of that. The outlook of a slow growth has prompted 43 in the survey respondents to lower expectations for Fed rate hikes. A weak outlook for growth abroad knocks about 40 basis points. That is 0.4% off of GNP forecast this year. trade deal expectation. Good news that most respondents expect a trade deal with China, but a trade deal with China has two edges to it. Well, 79% expect a deal, just 2% see a fourth round of taxes and tariffs, and 17% expect a continuance. So you're going to have some difference of opinion. Fewer tax hikes here from the Fed. No tax hikes in March. 100% said that. In 2016, 60% say there will be a hike, and 14% a cut. 2020, 51% said there's a hike, and 35% a cut. So this is the survey. On to Goldman Sachs, they plan to hire more African Americans and Latinos. Their goals here is aiming to ensure 14% of new analysts and associates in America are Latinos, 11% are African Americans. That's according to a memo seen by Reuters. 9% entry-level jobs to African Americans in the UK, although they've cut back on a UK operation. So some of the news coming here. Let's go, before we do the numbers, let me just check something here. Okay. The Foxconn plant in Wisconsin, this is from the Sentinel Journal here. Sentinel Journal. The Foxconn Group said on Monday that the next phase of its construction on its announced flat screen plant in Racine County will begin this summer. It's called Glen 6 Liquid Crystal Plant, or Fab. It's actually called a Fab. The announcement follows this. Wu's visit to Wisconsin came 6 weeks after reports that Foxconn might not locate a factory in Mount Pleasant. After all, the reports prompted DJ Trump to call the government. The announcement reiterated on February the 1st. Besides saying construction will move forward in the summer, Foxconn said it will award contracts by the 1st of April for work on utilities, roads, and storm drainage in Mount Pleasant. I guess that's where they are locating here. And last week's talk, Wu also met with the new governor of Wisconsin, Evers, and they had announced this enormous plan. It will not be as enormous as one would say and what else? Let's wind this down here. Basically asked Money whether he would consider it a breach of contract if Foxconn doesn't build the larger plant. Like any good partner, we're going to sit down and talk about it. That's DeLabers. Cutting around the article here. We have a development agreement. It says Gen 10. We think it's moved beyond going discussion in terms of how that equates to our local development plan. But we're static about Gen 6. I guess if you can't get Gen 6, you get Gen 10, you get Gen 6. We don't know. Skepticism intensified. Oh, that was that was a generation 10.5 plant in the state. Now down to Gen 6 that it will build and can manufacture much larger screens. The company said this is a changing global market. So in other words, the market has changed. They have changed. And let's do the numbers. Now we'll start with the FTSE. It was up 0.36. Okay. That's today. A little different. In Amsterdam, they're up 0.38. In France, they're up 0.39. The DAC is up 0.76. The STAS 50 is up 0.9. 5.9. Excuse me. And in Madrid, they're up 0.67. And we'll jump to Asia. The Sensex is closed in Bombay there at 0.70, and Hang Seng is also closed at 0.19%, and Nikkei closed at a negative 0.08% there. And let's see, the Dow, it's closed according to this. Okay, so they're just about to open. Anyway, they were at 0.25, and the Nasdaq at 0.34. That was on yesterday. And in Chicago, they were at 0.37. So they had a day of it, as they say. So we've finished the markets. I think we've got just about everyone covered here. We'll go on to Jerome Powell. He was testifying at the House Committee, Finance Committee. That's part of the Humphrey Hawkins annual report, semi-annual report that they give to both the House and the Senate, named after the Representative Augustus Hawkins out of South Central Los Angeles. It's interesting. Maxine Waters, who is chair of that committee, is also from South Central Los Angeles. And on the Senate part, it was Hubert Humphrey, the senator from Minnesota. Thus, we get that valuable testimony there. For those in business, make it a productive week going forward. We're on Tuesday now, the 19th of March, 2019. And the consumer, obviously, the eye is on the prize. As Dr. Curtin was talking about, the lower half of income part of consumers are keeping the ball going. That's an interesting prospect there with the psychology of the market, that things are happening at that particular part of the economy, and we'll continue to keep our eye on that particular ball. And another side note here, the campaign of Bernie Sanders for President 2020 is in the process now of unionizing, a first there.